Hi, everyone, and welcome back to our podcast here at VHA Accounting. Today, we are unpacking something that trips up a lot of business owners: the difference between an installment sale agreement, a hire purchase agreement, a lease agreement, and just buying something outright. We'll chat about what each one means, how they are treated for tax in South Africa, how they are recorded in the books, and I'll give you some tips on which option might be the best for cash flow and interest deductions. Let's start with the simplest one: outright buying. Definition: you pay for the asset in full right away. You own the asset immediately. Here is an example. You buy a delivery van for your business for 300,000 Rand cash. The accounting treatment: record the van as an asset at cost and reduce your bank account. Tax purposes: you can claim the wear and tear allowances depending on SARS rules. For example, a motor vehicle, usually over 4 years, no interest deduction because there's no borrowing. Cash flow: the big downside. Cash leaves your bank in one big hit. Great if you have the cash and want to avoid debt, but it can drain working capital. The next one is installment sale or hire purchase. These are very similar in South Africa and often used interchangeably. Definition: you take ownership of the asset immediately, but pay it off over time in agreed installments. There's usually interest involved. Sometimes hire purchase means ownership only transfers after the last payment. But for tax, installment sales and HP are treated similarly. Example: you buy a machine for 500,000, pay a deposit of 100,000, and finance the rest over 3 years. The accounting treatment: the asset value goes on your books upfront, along with a liability for the amount still owed. Interest is recorded as an expense over the life of the agreement. The tax treatment: you can claim wear and tear as if you bought the asset in full, and you can deduct the interest portion of your payments. Cash flow: this spreads out the cost, and because you own the asset, you benefit from depreciation and interest deductions, but you still take on debt. The next one is the lease or rental agreement. So, by definition, you don't own the asset, you are basically renting the asset. You pay a monthly or quarterly fee to use it. At the end of the lease, you either return it or sometimes have the option to buy it for a small amount. Let me give you a practical example. You lease office photocopiers for 5,000 Rand a month over 3 years. You never own them unless you pay a buyout fee at the end. The accounting treatment: traditionally, leases were just expensed as you paid them. But under IFRS 16 or the new lease rules, you might have to recognize a right of use asset and a lease liability, depending on whether it's an operating or finance lease. Many SMEs under IFRS for SMEs still treat operating leases as straight expenses. Tax purpose treatment: lease payments are usually fully deductible as an expense. There's no asset on your tax balance sheet, no depreciation to claim. Cash flow: great for preserving cash and avoiding large upfront costs. The downside here is you never really build equity in the asset. So, what's best for you? It really depends on your needs and your financial plan. If you have lots of cash, outright buying saves interest costs, but watch out for draining your working capital. If you want tax deductions and ownership, installment sale is often the best. You claim wear and tear, deduct interest, and spread payments. If you want flexibility and no asset risk, lease or rental keeps payments predictable and offloads maintenance or resale risk. So let's put an example to tie it together. Imagine you own a delivery vehicle worth 300,000 Rand. Buying outright, you're going to pay 300,000 now, no interest, but no cash left for other needs. Installment sale, pay 60,000 Rand deposit, 8,000 Rand a month for 3 years. You eventually own the van. Now claim the wear and tear and deduct interest. Lease, pay 7,500 Rand a month for 3 years. You expense it fully but never own the actual asset. So the choice really depends on your priorities, cash flow, ownership, and tax position. For many small businesses in South Africa, an installment sale hits the sweet spot. You get the asset now, spread out the payments, and enjoy the tax perks. But in some industries, leasing makes sense because technology changes so fast or because you just can't tie up your cash. Well, this may feel like small decisions. They can really impact the financial plan and health of your business. It is a good idea to have a capex budget and even run these ideas past your accountant or advisor beforehand. Until next time, I'm Vidyanth Bhola, and please like, share, and subscribe to the channel. And if you have any other topics that you would like me to cover, please may I request you put your comments in the comments bar of what you would like me to cover. Until next time, it's Vidyanth Bhola. Cheers.